Hi, I'm Amelia Harris from My Property Circles, and I have with me Brian from Goodridge Advisory, and I'm welcoming you here for the Fast 15, and it is the accounting ins and outs of investing in a property with many people. So without further ado, let's get into it, Brian.
Sounds good, Amelia.
Now, before I start, I'd just like to just say that any advice you hear here today is general advice only. And we haven't taken into consideration your personal circumstances. So we highly recommend going and seeing someone like Brian, an accountant or a financial planner, and discussing your circumstances and deciding whether a property circle or investing is right for you. So Brian is a CPA accountant, and he is the owner of Goodridge Advisory. Welcome, Brian.
Thanks, Amelia. Great to be here.
Good to have you. And he has been helping us with some of the circles that we've set up of recent. And so I'm here to ask him a few questions. So, Brian, can you just tell us a bit about you and about what you specialise in?
Yeah, so I've got my accounting firm, as you said. We've been going for almost 9 years now. One area is we specialise in is property. So I've got a passion for property. My wife Laura's got a passion for property. And so that's really driven us to want to help people in the property space.
Right.
And then outside of that, we've got 3 kids that are a massive handful.
Yes,
I understand that. And so between the accounting practice and our kids, it doesn't leave us too much time, but we have our veggie gardens and that sort of thing in our spare time.
Wonderful, yeah. That's good to hear. And so you've been working with My Property Circles for a little bit, and I just want to speak to the listeners about ways you can invest in a property, and ways you can invest in a property as a group.
So there's all sorts of different ways you can invest in a property as a group. Hundreds of different ways to do it. But the way that I think is generally the best is for people to invest in property as a group through unit trust.
And why is that?
So that's really important, and it's a great question. So when you've got a unit trust, all the profit is distributed for tax purposes out to the individual unit holders. And so that way, from a tax point of view, they're not tied up together as they would be in the same company.
Yes.
And so there's no issues around that. So let's say we invested in the company instead. If we decided that we wanted to sell the property after a couple of years and the sale goes through in February, if we pay the dividend out of the profit, then the tax credits that the company is going to get once it pays its tax on that won't be available for next year, so we miss out on that.
Okay.
Whereas if we've got a unit trust, it all just comes out in 1 year, every individual unit holder, their tax is their problem, to deal with whatever way they want, and they're not tied up with the rest of the group.
Yes, okay, that makes sense. And so one of the other ways that some people buy property as a group, so to speak, is by putting 2 names on a contract. So can you tell me why that's a good or a bad idea?
So I really don't like just 2 names on a contract, because you're essentially going to business with someone when you do that.
Mm-hmm.
And there's no protection.
Okay.
So
what do you mean by that? So just say, like, I put my name on with my best friend and I ended up going bankrupt. What happens to my best friend?
She's probably going to have that. But the whole property is probably going to be sold.
Okay.
So your profit can cover the share of the debt or your debt.
Yes.
And the other thing that can go wrong is if your friend wants to get out of the property, you've got no structure in place, you've got no agreement in place to sort of rule how that's going to work.
Yes, okay.
And so she could potentially just put the property for sale if she owned, say, 51% and do that for you.
Yes, okay. And that's one of the things, I guess, with My Property Circles that we speak about because we use a unit trust. And in the agreement, we speak about that there's no fire sale, because it's been written into the agreement that if someone wants to sell, they can sell their units, or they can, the property has 2 years to sell, so there's not a quick sale. It's able to sell in the best part of the market, essentially.
Oh, that's so important, because then having that stops people sort of holding it out to somebody else.
Yes, okay.
So you might remember in the conference right last week,
Yeah, so tell that story again. That was a really interesting one of one of your clients, if it was.
Yeah, so they weren't property investors, they were real estate agents.
Mhm.
And there was two best friends running a real estate agency. Everything went fine for a number of years.
Yes.
Then the main guy decided to get his cousin involved, and that was again fine.
Yep.
Then he decided to get his girlfriend involved. And so it lasted about a month before they couldn't be in the same room as each other without wanting to kill each other. But they had no agreement in place. And so the only thing they could agree on was they should give the whole thing to a liquidator to just close down.
Oh, right.
And I said to one of the partners, look, you realise that if you just sold the rent roll and didn't go through the liquidator, you'd all walk away with a lot more money.
Mm.
And he said to me, I know that, but I'm a lot wealthier than these guys and they've upset me, so I want to see them suffer.
Wow.
And so it's really important that we've got these sort of agreements set up that my property circles do.
Yes.
So it stops that sort of situation happening.
Yes, and I think we spoke about last week in the conference is that when setting up a property circle, you speak about your the strategy that you're going into, so the investment strategy, how long you want to hold a property for, how much you want to invest for, where you want to invest, if you want to do renovations, what people's tasks are or what they're in charge of in the circle. So it's really important to set up that pre-contract almost information between parties.
So important. And often when I'm setting up businesses, whether it's an investment or a business, with two or more parties, they'll say, oh yeah, we're friends, everything's good, don't worry about it.
Yeah.
And I always say to them, it's good until it's not good.
Yes.
And usually from going from being good to not good is a very short space of time.
Yes.
And you can't do anything in that time frame.
Yes. Yeah. So you just touched before on tax. And so what happens with the tax situation in a unit trust?
Yep, so the unit trust makes whatever profit it makes.
Yep.
And that's distributed according to the unit holding in the unit trust.
Yes.
So let's say we had a unit trust between the two of us.
Yes.
And you had 6 units and I had 4.
Yep.
And we made $100.
Mm-hmm.
So you get $60 and I get $40.
Okay, great. And then I take that $60 and that goes out into my individual tax bracket. Is that right?
Yes, that goes into your tax return.
Yes.
Now,
okay.
what we look at from the individual point of view, in their situation, is it better to hold the units in some other entity for tax purposes or asset protection, depending on what they've got going on.
Yes, okay. So you're saying that instead of an individual holding it, potentially a company could hold it.
Potentially, or maybe a discretionary trust, depending on the situation.
Yes, okay, great. And then I had it on the tip of my tongue and then it's gone poof. And so another question that I always get asked is, can I invest with my self-managed super fund?
So the short answer is maybe.
Okay.
So when you've got a unit trust, you've got a self-managed super fund investing in it. The unit trust can't have any borrowings.
Okay.
So there's restrictions on that, and then you've got to look at, are we just buying property as a passive investment, or are we doing a development, something like that? Because overarching everything else with self-managed super fund is the principle that the money in the self-managed super fund is there for the sole purpose of providing for retirement.
Yes, okay.
So we've got to make sure we cover up on those things.
Yes, okay. So that is definitely a speak to your accountant question.
100%. I would never do anything like that with self-managed super fund.
Yes.
I've got advice.
Yes, okay, great. Okay, so note to everybody out there. And so can another one I always get asked is, can you keep the earnings in the circle? We always say that you basically pay out the distributions each year, but can you be keeping the profit in the circle or loss? Like we've spoken about loss, but what happens there?
Yeah, so if it's a loss, they can't distribute, so it stays there.
Yes.
If it's profit from the tax point of view, it's got to be distributed, tax to be paid.
Yes.
But we can leave the money sitting there.
Mm-hmm.
And that essentially becomes a loan from the unit holders to roll into the next property and so forth.
Okay, great. Okay, wonderful. And then another question we get asked is foreign ownership. Is it allowed in a property circle?
Yes, but so you've got to, most property investments by foreigners have to go through the Foreign Investment Review Board.
Yes. Okay.
And then there's restrictions. So I believe they can't invest in existing residential property. It's going to be new residential property,
Okay.
or they have to be intended to do development and things like that.
Okay, great.
So if we're looking to get someone who's a foreign national to invest to a circle, we definitely want to take advice before we do that.
Yes, okay.
There's some pretty steep penalties if we get it wrong.
Yes, okay, great. And now, so like obviously all these questions have really proven that it's really important to get advice before you start investing and going into a property circle. Brian kindly does offer a 15-minute session with any member who wants to come to join a property circle, just to have that initial practice to see if it's the right thing to do.
Well, the other thing you touched on is just around asset protection.
Okay, yes.
So when you're setting up a structure, tax is really important.
Yes.
Asset protection is really important.
Okay, so what do you mean by that?
So I've never seen someone who's 42.
Yes.
But as soon as you've got some money, you get the target payment on your back, and the target gets bigger with the more money you've got.
Yes.
And so it's really important to have a structure set up so that we're separating the assets from the risks.
Okay.
So what I do with people is I draw a big page and I draw a T on the page.
Mm-hmm.
And one heading is assets and the other heading is risk.
Yeah.
And we work out how we can get all the risk on one side of the column and all the assets on the other side.
Yes. Okay.
And so we have a husband and wife example. We have one with ownership or control over all the assets, the other one's got all the risk. So if the worst thing happens and the person with the risk goes bankrupt,
yes,
they still go home to the same house they've lived in for the last 20 years, still have all the investment properties and share portfolios, whatever, and the Ferrari in the garage and whatever else they've got, because it's all being separated.
Okay, and so I'm going to just delve a little bit deeper into that. So because obviously most mums and dads would have their family home in their individual names.
Yep.
For obviously capital gains, tax, etc., etc. So would you suggest changing that, or is that separate?
Again, that's a maybe one. So there's a principle of law called the presumption of advancement, where you can sort of say, I've always intended my spouse to own my share of the property.
Mm-hmm.
That was challenged in a recent case that was only handed down less than a month ago. But talking to some solicitors, they reckon that's a kind of special case. So it probably still works.
Okay.
The relative of each individual circumstance. So if you're like a low risk category, I wouldn't need to worry.
Yes.
If one of the, say the wife was a heart surgeon,
yes,
it's a pretty risky sort of occupation.
Yeah.
You probably want to have no assets in their name,
yes.
just in case.
Yes, okay, yeah, that makes sense.
Yeah.
And then my other question that I want to ask you is about children. So can children invest in a unit trust structure for buying property?
So under 18, their units have to be held on trust for them.
Okay.
The other thing we've got to be careful of is if we've got minors and receiving unearned income, so like interest from rent and stuff like that, anything over $416, they get taxed at a penalty rate, 66%.
Oh, wow.
Up to a certain point, then stop margin rate. So
okay.
From a tax point of view, you don't want to be doing that with minors.
No, okay.
If they're adult children, 100% you can do it. The main consideration is investment horizon and that sort of thing.
Yes, okay. Yeah. And then potentially with the younger children, you could set up a discretionary trust to invest, maybe. Would that work or not? And then not pay them out or something? Yeah,
potentially. So you have the discretionary trust and then only pay it out when they turn 18.
Yes.
So they go to university and don't earn any money.
Yes.
In that situation, you just got to be careful that discretionary trusts often have to pay higher rates of land tax.
Oh, okay. Is that right? Okay. Yes.
Depending on which state you're in, they don't have the same threshold as individuals. So you need to have a look at that and decide whether it's worth it or not.
Okay, that's really interesting. Okay, we've got a question here, and I'm blind, so this is going to be difficult. How is land tax handled in a property circle?
Because it's a unit trust, and if you've got it set up right, so say New South Wales, it's got to be set up specifically with the New South Wales land tax legislation. The land tax, the land value is assigned to each unit holder, and then aggregated with whatever other land they've got to work out the individual land tax.
Okay, that's really interesting.
Yeah, so the unit trust gets an assessment and then it passes down.
Okay, that's really interesting. So I'm going to just bring up the contact details because I'm sure if you do have any questions, then you're more than welcome to either contact Brian or myself. and we'd love to hear from you. And yeah, as I said, like, with all these questions, it's really important to speak to your accountant and or Brian. Because there's lots of ins and outs of it, and ways to do things and ways not to do things. So thank you so much for joining us, Brian. I really appreciate it, and it's really interesting, and we could go on for a long time, but we've got lunch, so yeah. So thank you so much.
No, my absolute pleasure.
And thanks for joining us.